Recently, I heard something. Why do we pronounce the G in longevity twice? I'll wait. Crazy, right? Now I can't unhear it. But this isn't fun facts from doom scrolling. Welcome to Covering HOAs with One Hot Mic. Recently, we talked about deductibles, insurance deductibles, what they are, what the story is, why are they there? We're going to dive a little deeper today so we can help understand how the deductible plays a part in the insurance process. The guiding light, the constitution, if you will, the governing document of a community association is called the Covenants, Conditions, and Restrictions, CC&R. I personally don't say CC&Rs because it's already plural. It's covenants, conditions, and restrictions. Saying CC&Rs is like saying RBIs. There are already runs batted in. There's not runs batted ins, but I digress. You'll find that I do that quite a bit. Bottom line, I say CC&R. Some say CC&Rs. Same thing. The CC&R define for us what the HOA's responsibility is and what each owner, each member's responsibilities are. And that can be maintenance responsibilities, who's responsible to maintain, care for the roof, who's responsible to maintain, care for what's inside the unit. But often, because there's also an insurance section within these documents, often the insurance section and the maintenance section don't agree. That is, an association is responsible to maintain the exterior of a building. Speaking condominium world, by the way. And the unit owner is responsible to maintain the interior of the building or the unit. But the document, the CC&R, may say the association has to buy insurance for the property the unit owner maintains. And that can be a little, let's say, inequitable, because in my mind, I shouldn't be paying assessments. Assessments pay premium. Premium purchases the insurance policy that's for my benefit as a unit owner. I shouldn't be paying for something that is going to provide a benefit to someone else if I never have to use it. And while water losses and fires claims in general are increasing in frequency, they're still not 100%. Not everybody is going to sustain a water loss. So if my neighbor has a burst pipe and their floors are damaged, well, and my policy or the association's policy includes coverage for that property, then the association's policy is going to pay to repair my neighbor's stuff. Yes, that policy was purchased for their benefit with assessments, portion of the assessments that we all pay. I get that. I respect that. But the condition of that property, the quality of that property is not something that's in question. It's just their property. There are some things we'll get into in a little bit about how we kind of divide up that property or insure that property differently. But by and large, 30,000 foot view, policy that I pay for that I'm not benefiting from is benefiting someone else. Yes, they're paying for it. But in the end, we're all going to pay for it, because if we have too many claims, the cost of insurance for the association is going to go up. And again, not everybody is sustaining or not everybody is experiencing a claim. So when the cost of insurance goes up because, let's say, 5 owners in a 100-unit complex have had a water loss, we all pay the price. The best thing for us to do, my opinion, the best thing for us to do is try to align those two things. Try to align the maintenance responsibility and the insurance responsibility. So if we have this responsibility kind of inequitability, and we want to put more responsibility on the unit owner to insure property they are responsible for maintaining, what can we do? Back in the day, it never would have been a question. And I'll say, let's say. Will I say or will you say? let's go with, I'll say, maybe 15 years ago at this point. If I had a water loss in my unit and I said to my insurance company, hey, I have a water loss and I need your help fixing it, or I need your help paying for the repairs, my insurance company would have said, most likely, you know what? That water loss started from a pipe in your property, in your unit. It started from, let's say, a kitchen angle stop under the sink, and the water damaged your property, the floors and cabinets within your unit. So we, your insurance company, are going to pay for the damage. We're going to cover the cost. It's a burst pipe. It's a covered loss. Here's your money. Well, carriers understood, personal lines carriers, those condominium unit owners carriers, personal carriers, learned that the association's policy is actually primary when it comes to property damage. So, wait, the association is first, and then the unit owner's policy kicks in? Well, why are we spending money before we know what the HOA is going to do, what the HOA's insurance carrier is going to do? With all of these claims that we're paying, we're not collecting enough premium. So we're literally drowning in the cost of paying for these claims. What can we do to put the responsibility to addressing those claims on the HOA, who is primary? The answer is we're going to make the HOA pay first. We're going to make the HOA look at the loss first. We're going to make the HOA tell us whether this loss is going to be covered by the association's carrier, or it's all on us, the unit owner's carrier. So personal lines carriers had to figure out how to put more responsibility, or at least accept less responsibility for the claims that were drowning them, because they're paying more money in water claims in particular. And like I said, they found out the HOA policy is primary. So let's go see what the HOA carrier has to say. And if the HOA carrier is going to cover some of this, let's let them cover it first, because that's their responsibility. So we started to do that for a bit. And then the HOA carriers started to say, well, we're sustaining a whole bunch of losses. We're actually injuring profitability. Insurance companies look at the cost of a claim against the money brought in for premium. It's called the loss ratio. There's a number of ratios. Don't worry about them. Bottom line is, if they're taking in more, or they're taking in less money than they are paying out in claims, they're not making money. And so insurance companies say, well, how do we know now that we are responsible, that we are primary? We've always been, by the way, always been primary. It's never been a question. It was just nobody thought about it. And so for years and years and years and years, nothing changed. The insurance company says, how do I mitigate the losses I'm sustaining? Because I can't raise my premium dramatically. All kinds of logistical problems with that, political problems, Department of Insurance issues, difficulties with that. But how do I mitigate the losses I'm paying? The answer is, let's increase the deductible. So we went from some communities that had $1,000 per claim deductibles to $5,000, $10,000, $25,000 is actually probably most common these days. Even a $50,000 loss or $50,000 deductible. Some carriers have implemented deductibles for water specific claims against any other type of claim. But the point of the deductible is to put more responsibility on the party who is maintaining the property that is damaged. The ultimate way to do that is through revising the CC&R, because there's three ways to cover interior fixtures per CC&R language. One is walls in. So we look at the structure of the building, from the exterior of the building through to the interior surface of the drywall. Everything that's inside that unit, pick it up and flip it over. Everything that stays stuck inside is insured by the association or through the association's insurance policy. That's called walls in. That means floor coverings, cabinets, countertops, bathroom fixtures, all that stuff that is there immediately prior to the loss is covered through the HOA policy. To go back to the beginning of the discussion, it's covered in the policy that all the members are paying assessments towards, and it is paid for their benefit. And it makes sense a long time ago to say, well, there's an economy of scale here that makes it cheaper for an owner or owners to pay a certain portion of the premium, and then we'll buy an insurance policy for everyone because it's cheaper than you buying insurance for yourself. That's certainly changed. But when you have a walls in policy, we're insuring everything. Italian saltillo tiles, they may not be, so that may be Spanish. I sell insurance. I'm not an interior designer. Point is, things that are upgraded, updated, high quality fixtures and finishes are now insured by the association, and the association had no involvement in putting those fixtures in and has no involvement in maintaining them or repairing them when they are damaged or if they are damaged. So that's one, walls in, right? Number two is what lenders have decided to call, it's not an insurance term, but what lenders have called single entity. Easily understood as walls in excluding improvements and betterments. If we pick that unit up and we flip it over, we're talking about everything that stays stuck inside, but we're only insuring what the original installation, the original component that was installed. We're not insuring any of those upgrades made by the unit owner. This is more equitable for the community because, especially in older communities, we're looking at a much lower cost, a much lower price to those fixtures or finishes that were originally installed. And then the owner is going to take up the difference or the delta. Yes, there's a little bit of a kind of a gray area on, well, how do we tell what the difference is? My condo was built in 1975 and it had green shag carpeting. What we're talking about are the typical basic finishes, fixtures. And then the owner would say, okay, well, I took out the shag carpet and I put in hardwood floors. Insurance company will provide the money that would have been put back a carpet of basic quality. And then the owner would pay the difference between that basic quality and their hardwood floors. We're not going to put back the basic carpet and then make the owner take it out and reinstall floors. That's silly. Just throwing a number out. If $1,000 was available for use in the floors, then we're going to provide that. The insurance company is going to provide that. And then if it's $5,000 to insure, or pardon me, to replace the floors, the owner has $1,000 from the insurance policy for the association, which was purchased for his benefit, their benefit. And then the owner has to come up with the other $4,000. That's the difference. So one, walls in. Two, walls in excluding improvements or single entity. And the other option is what we call bare walls. If we stand in the threshold of your condominium unit, hand on the outside of the building, hand on the inside of the drywall, inside wall. We're talking about everything that's inside or everything that's included between your palms. Nothing on the inside of the unit is insured by the association. Pick it up, flip it over. Everything that stays stuck inside is insured by, responsible for, or responsibility of the unit owner. And the owner can buy insurance for that. But the point is now, my view, my opinion, we are now in a more equitable situation. I'm paying assessments. Assessments are paying premium. And that premium is being applied to a policy that ensures the structure of the building that the association is responsible to maintain. It is not paying for the possible replacement of someone else's brand new kitchen. One way to put the responsibility, more responsibility for those losses on the inside of the unit, is to increase the deductible. And the other one is to revise the CC&R if you have one that is walls in or walls in excluding improvements, and revise it to a bare walls policy. Few benefits to doing that for your communities. One is you protect insurability of the community, especially if you're sustaining a lot of water losses. Claims aren't going to be filed for property that's not covered. So you're not going to experience that water or that loss history due to water claims. Again, the responsibility for the property on the inside of the unit, which is the owners to maintain, is now the owners to insure. That makes more sense. And actually, there's a little bit of a financial benefit on premium right up front. Whatever it is that is estimated for the cost to insure property inside of a condominium unit, we don't need that insurance. We don't need that limit of insurance. We can remove that from the total insurable value of the community. And by removing property insurance, we remove property insurance premium. So there is a way to save a little bit of money. Throwing numbers out, 10%, 15%, sometimes 20%, depending on how your properties are insured. So there is a value, there's a financial benefit to that as well, because you can then get some premium relief by simply removing coverage. Well, Mike, we get premium relief by removing certain coverages, but don't we put the burden on the homeowner, the unit owner now, to buy that insurance? Isn't that going to cost more for them? Yes, you're going to have to buy insurance for that property you are now responsible for, but you're going to do it at a lesser cost than your portion of the assessment that's paying for insurance for the association to cover all the property of everybody, all the interior property of everybody in the community. Most carriers charge between $2 and $4 per thousand. So let's take right in the middle, $3 per thousand for interior coverage for interior fixtures. And this, depending on your carrier, this could come in as building property, dwelling coverage, additions and alterations, improvements and betterments. Whatever it is, talk to your agent, talk to your broker, and say, I need insurance for the stuff that if I pick my unit up and flip it over, I need insurance for everything that stays stuck inside. Floor coverings, cabinets, countertops, bathroom fixtures. I need that stuff. And they'll understand what you're asking for. If they don't understand, get a new broker, but they will understand. Also, if they don't understand or they have questions, they want to be sure, they want to be clear for you on what the association is covering, give them the phone number of the broker who's insuring the association. It's on your certificate of insurance. The certificate of insurance has the number of the broker and email address of the broker, for that matter, that is insuring the association. So you can just give them that number. They would call. I used to do this all the time when I was a farmer's agent and writing single family homes and condominium unit owners policies. Show me the certificate for the association, and then I'll call the broker, I'll call the agent, and I'll make sure I'll clear it up. It's part of my service, part of a service to a client. You may not be able to find the certificate. Sometimes you have to call your management firm to get a copy, but you do have a copy of it, and you are given a copy of it every year at budget season. It's part of the civil code. You have to get it in the financial disclosures. So it's there somewhere. It's just a question of whether you put it in a file cabinet or round filed it, and it's now in some landfill somewhere. Oh, hey, look, I digress. Back to the lab. The insurance for that interior finishes, fixtures, improvements is roughly $3 per thousand. If I have 1,000 unit condominium, replacement cost on that condominium is now probably in the interiors is probably around $125 to $150 per square foot. On $1,000, we're talking about $150,000 for all the interior finishes, fixtures, improvements. $150,000 is 150 thousands. So 150 times 3 is $450 a year. Well, that's the cost to the unit owner. If the association is to move to bare walls, we're increasing their cost, their exposure, their expenses by $450 a year, less than $40 a month. Now, it's not easy to revise the CC&R. I say all the time that apathy is the cancer of a community, and getting people to care, getting people involved is a very difficult thing. But all we can do is explain to the membership why we're doing this, why we are making this decision, why are we pushing this responsibility onto the owner. For example, well, we paid $50,000 for our property insurance premium last year. and pretty much the same over the last few years. But we've sustained a lot of water damage, a lot of water claims. And the insurance company is saying, I don't want to insure you anymore unless you either pay this high premium or take these high deductibles. And sometimes it's both. Our premium went from $50,000 to $150,000 this year. It tripled. And it's due to the claims. So we need to find a way that the association's insurance company is not paying for those claims. Here's how we do it. We revise the CC&R so that the unit owner is responsible to insure the property inside their unit. There's also the concern of, well, but Mike, if the pipe is in the wall and the pipe is the responsibility of the association to maintain, then isn't the association responsible for the damage the water did because it was the association's, wait for it, fault that the pipe caused damage to my unit? No, it is not. Because fault implies liability. Fault implies responsibility. It's not the association's fault that a pipe that's inside of a wall burst and caused damage. They didn't do anything wrong. It wasn't like they could go into the wall and say, oh, look at that pipe. It's about to burst. We better replace it. Go into the wall and say, oh, these pipes look great. No problem. Patch it up. Nope. It just happened. It happened and your unit was damaged. And that's a sad but true story. So it's not my pipe. It's not my property. It's not my problem. This is your property inside the unit. The association is responsible for property outside the unit. Or let's take it to a different place. What if a pipe under my sink bursts and I'm on the second floor and downstairs below me is another unit? And that unit owner is saying to me, hey, you upstairs, you owe me for the cost to fix my unit because it was your pipe. Are you immediately responsible for the repairs to that person's unit? No. Unless you were negligent in the maintenance of the thing that caused the loss and therefore liable, i.e. responsible for the damage caused, then you don't owe them anything. You don't owe them the cost of repairs because water flows downhill and gravity works. I'm being very candid here, but that's the truth. You don't owe for something just because it happened. Okay, Mike. So what about this big deductible you're talking about? We have a $50,000 deductible for water damage in our association. And so you're telling me that the association is going to have to pay $50,000 in every water claim out of its own pocket so that because the association is the one that chose that deductible? No, I'm not saying that. Because if you recall, maybe not from this chit chat, but previous chit chats, the deductible is not a bill. It's not an invoice. It's not a chargeback. It is an amount of money that is deductible from the payment of a claim. Not only is it deductible, the insurance company is going to deduct it. Or put a different way, it's part of the agreement that the insured, in this case the association, and the insurance company made for the insurance company to take on this risk, for the association to transfer this risk of loss, financial loss, to the insurance company. Insurance company said, sure, we'll take on your risk. However, you are going to allow us to deduct $50,000, in this example, $50,000 from the payment of any covered claim, property claim. The association says, okay, great. That's fantastic. We'll handle it. Like I said, we can buy coverage for it on the HO6. No one's left holding a $50,000 bag. Well, unless they don't buy insurance. But the association isn't responsible for that amount of money because that amount of money is part of what The cost is to repair the unit owner's property. It's unit owner's property, not necessarily association's property. If there's no common area damage, why would the association come into someone's home and provide $50,000, even $5,000, to fix the interior of someone's unit because the deductible and the HOA policy was whatever it is? You're paying money for things you don't maintain. And if I took that a step further, I could say, you're paying money that I paid in assessments for operational expenses to this community, and you're using my money to fix that person's stuff. That's really not fair. And that's really going to cause a problem if other people find out. I spend $500 a month on assessments, and you just sent a portion of my money and everybody else's money to someone else to fix their unit, fix stuff that is theirs to maintain. That's really frustrating. Tell you what, I spend $500 a month and I need maintenance done on my car. Can I have some money, please? Doesn't work that way. So don't think of the deductible as this invoice chargeback deductible. Think about it as just an amount of repair costs that are ultimately going to be left over. Let's put it into context. $150,000 water damage claim. $50,000 deductible. The association is the insured. The association therefore receives $100,000, $150,000 loss, $50,000 deductible, take the $50,000 away, $100,000 net. Here insured, here association is your $100,000 to make repairs, to put towards the repairs of this property that was damaged in a covered loss. Remember, it's $150,000 total, but now we have $100,000. What are we going to do first? Pay the remediation contractor. Pay the contractor to clean things up, dry things out. It's really hard to tell the difference between common area, unit owner's space, unit owner's airspace. Just dry it out, pay it up, pay it. You have the funds to pay the contractor, pay the contractor. Then use what's left over, what's remaining, to fix property that is common area property. We have property between the walls, inside the walls. We have the exterior, the building, roof, what have you. If any of that was affected, use the money you have now from the insurance company, the insurance proceeds, to fix association property first. It's the association's policy. It should go to fix the association's property. And lastly, once we've worked from we dry everything out and we work from the exterior through to the interior surface of the drywall, we're inside the unit now where the unit owner's stuff needs to be repaired, replaced. Whatever proceeds we have left in that covered loss, we can give to the unit owner, essentially. We can do that either by writing them a check or writing a check to the contractors that they've chosen to make the repairs to their unit. Either way, it's money that is there to make repairs to covered property that was on the inside of this unit. When we run out, where are we going to be? We're going to be short $50,000. The deductible, the amount that was deducted from the payment of this claim. And what property still needs to be repaired? Property on the inside of the unit, which is the unit owner's responsibility to maintain. So the unit owner uses whatever resources they have. Hopefully they have their own insurance or a lot of money in the bank or a really rich uncle. But the property that's left over to be repaired is not association property. It's not association maintained property, and therefore the association has no responsibility to do anything with it at all. That's it. That's how the deductible works. To get things to the unit owner, it's the unit owner's responsibility. And then the unit owner uses their own insurance to make to cover the rest of the expenses. So I mentioned that revising the CC&R is a really difficult thing because most people don't care, don't get involved. because of the apathy of the community. Getting people to know the why behind why we're making this decision is really important. It's important to hold town hall meetings. It's important to send letters to the membership. It's important to share as much information as you can so that the owners will start to hear the reason and potentially maybe get involved. Decisions are made by those who show up. And when you send out this letter that says we're going to be revising the CC&R, we'd be putting this responsibility on you, someone's going to say, why didn't you notify us of this before? Or when you send out a letter that says, hey, our insurance premium just tripled because of water claims, they're going to say, why didn't you tell us about this before? Now that our assessments have to go up, or we have to do a special assessment to pay for the cost of insurance. Well, we actually did in our board meeting that was open forum where you could listen to the board discuss certain concepts, certain topics. There are some things that go on behind closed doors in executive session, and there are some rules about what needs to be shared and what doesn't need to be shared. But I'm not an attorney, so you won't. To know all that stuff, ask one of those guys. The homeowner, the unit owner, the member has an opportunity to learn what's going on. They just choose not to listen. And then when something happens that affects them, they scream and yell at from the mountaintops because they didn't know what was going on. This board is ridiculous. They don't communicate with us. Now, I'm not going to argue that there's some boards that are not good at communication. I challenge you to be the best at communication. Be as transparent as possible. As my friend Kimberly Lilly says, clarity is kindness. The more you can communicate with your membership, the more your membership will understand the decisions you've made. If you're going to send out a ballot to make a CC&R revision or do a special assessment, go door to door. Knock on doors. Ask people for their input, for their help. Tell them why this is happening. Because, again, they're not necessarily going to go to the board meeting until they get that ballot. And then they're going to come in with guns blazing and say, I can't believe you would ever do this to us. We can't afford this. The answer is no. I mean, very few of us can today. Marketing for insurance is ridiculous. It's out of control. It's out of control, but hopefully soon there will be some semblance to reality, regression in the market as carriers do things and as the Department of Insurance in various states makes decisions that allow insurance companies to make coverage decisions, pricing decisions that will help bring back preferred carriers to the market. We've gone so far away from the carriers that everybody knows in the TV commercials that you see. And we're all into the surplus market where nobody understands or nobody knows what the names of those carriers are. And everybody's afraid of them because they've never heard of them before. The whole kind of world of insurance has gone to this very regulated, but kind of loose space of, man, if you want to pay it, I'll charge it. Or in order for me to take on this risk, this is what I need in premium. And that can get really expensive. So hopefully some of the things that are happening within your state are helping move the needle in a very positive way. My recommendation is to go to your local legislator, go to cai.org. You can find a list of the chapter that's in your state, in your region. And within that chapter is an LAC, a Legislative Action Committee. That's a group of people, professionals within professional service providers like insurance agents, reserve analysts, accountants, attorneys, community management firms, community managers that are involved, and even homeowners. And I really hope we can get more homeowners involved across the board because you're the ones. You're the keystone. You're the thing that we do this for. Management companies are there to help the board. The board is there to help the community. But if homeowners don't get involved, then everything falls to somebody else running the joint, basically. That's not what you want. So get involved. But homeowners in the legislative action committees are so important. There's no words for it because you're the constituent. You're the one that legislator is relying on for a vote. If you have something that worries you about the insurance world and what's going on legislatively, learn from CLAC. Well, learn from the LAC, LAC, Legislative Action Committee. Learn from that group what it is that they're seeing that the legislators are pushing, what it is that the group is supporting, is rejecting, is pushing away from, or is wanting to revise. Get involved that way. That's the way you, we, us can help change this insurance crisis that's not only in California, but it is across the country. I would be remiss if I did not comment, mention, say hi, shout out LeBar Oxney Insurance, because LeBar Oxney Insurance is my employer, and they are giving me the freedom to put this together, to kind of chase this little dream of mine, to find a podcast audience that wants to learn about insurance and understand what's the what. So thank you to LeBar Oxney Insurance for this opportunity. Oh man, my biggest pet peeve right now, I don't like drivers. I don't like people on the road. They're just so inconsiderate. Somebody just goes up to the front all the way up, skips 5-6 cars, and just nudges their way in. What that does is slows everybody else down back here. I can't stand that. I'm okay. It bothers me. But when I take a deep breath and I think about what could be going on in that person's world, I don't know. Maybe they're just that impatient. Not my problem. Doesn't hurt me. Maybe they're rushing to the hospital. I'll pray for you. I hope you get there. I choose not to worry about that person. I choose to sit back, just listen to my music, listen to more of my podcast. I choose to let that moment go. And if that person is trying to get in front of me, it's me specifically, I'm going to make room. And I'm going to hope you give me one of those or one of these. I'm hoping that you'll respond with kindness. But if you don't, okay, you didn't respond with kindness. I don't have to worry about it. Let them be rude. Let them in front of you. Let them go on their way and not take you out of whatever good mood you're in. Please like, subscribe, comment, say hi. We'll see you next time on Covering HOAs with one hot mic. 3, 2, shit. I don't remember where I was.